Welcome to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main, president of Main Financial Group, as well as joined by Adam Freund, CRC of Main Financial Group. And to our viewers at home in the Detroit area, thank you for being with us. We're going to talk about something that everyone is curious about. They would like to have tax-free income in retirement. We know that you feel that way as well, sitting on the couch. But do you know, it's not just opening up an account. It takes proper planning and strategies. It has to have a way to get there. We're going to talk about the Roth today, not only the Roth conversion, but contributions, and also, when you think about it, just overall strategy so that you too can have tax-free income in retirement. Who doesn't want that? Tax-free income. Jordan, how are you today?
I'm pumped up for this topic today. As you know, this is great. Tax-free.
Yes.
Why wouldn't you want tax-free?
Why wouldn't you want that?
How are you today?
Fantastic. Always happy to be with both of you. Adam, how are you?
I'm doing fine. I'm just waiting for my next upgrade.
Okay. Sounds like a plan. Well, we're going to make sure you get an upgrade soon.
We've established in the past that I am apparently AI. So
sometimes he's not even really here. He takes a show or two off, but it looks like today he is here.
I am here.
Excellent.
Today.
Well, I am so glad that you're here because today's show is going to be great. A lot of people are really thinking about their tax exposure in retirement thanks to this show because you're talking about it every single week. So I have to ask you a question. Why do most retirees end up with most of their money in tax-deferred accounts, deferring the tax down the road? Why is that a common thread that we're seeing?
Yeah.
I think it's a misconception because people think, oh, I'm going to put money into this 401k or IRA and I'm going to get rid of my taxes. Well, it lowers your taxable income of that year, but really it potentially increases your tax down the line. So you're kicking the can down the street, if you will. But it's the most common form of saving, especially out of employers, right?
Yeah.
The pre-tax retirement accounts, 401ks, 403bs, all of that. And it really started with the creation of, what was it called, ERISA?
ERISA.
In the 70s, Employee Retirement Investment Savings
Account. Or Act. That's right.
Yeah, right. And so now we can funnel money, or employees could funnel money out of their paychecks into these pre-tax accounts. But the issue becomes now they're little IOUs to the IRS.
Oh, wow.
Tax bomb. Oh, there's Uncle Sam
Uncle
right
Sam.
there.
Yeah, I mean, look, when this came in, I understand the idea behind it, right? But basically, they've called it the greatest trick ever played on the public because what they did is they swapped out pensions for these 401ks, 403bs, 457 plans. Now, the idea behind it was wonderful. You know, it's almost a forced savings, right? You're forcing people more or less to start savings. And in fact, they said, hey, wait a minute, as a company, we'll help contribute to it too. They'll do a thing called matching. So that's great. But what they didn't really expect was this explosion in terms of not only were people putting in, but think about when, you know, for somebody like me, maybe I started in the 80s, right? Started putting in little by little, more by more. And suddenly now I have a 401k that's worth over $2 million, $3 million, not expecting that even in my remote mind back in the early 80s.
Well, and that's the big misconception is people don't realize that every dollar inside of those retirement accounts are 100% taxable as ordinary income to you, right?
Wow.
So every time you add a zero to that, 401k, let's say at the end of the year, oh, I've made another 10,000 or 100,000 or whatever it may be, that's just more tax that you're going to owe, and you're going to be forced to start taking money out down the line. So it becomes a major problem for most retirees without proper tax.
Well, I'm going to interject here just for a quick second because I looked some stuff up, and here are some key findings that they just did on a survey. 70% of Americans worry about taxes on their income in retirement.
Wow, 70%.
Makes sense. Okay. 70%. 70% worry that higher taxes in the future, which we never talk about, but higher taxes in the future. We're in the third lowest tax bracket right now. We know this deficit keeps growing and growing.
Yes.
There's got to be a time where we all pay the piper, right?
Absolutely.
So they're all worried about that. And 62% say they would stop using their current financial professional if they didn't help them navigate the current tax environment strategy.
Wow.
Yeah, in retirement, 30% tax savings, let's say, it becomes way more valuable than a 6, 7, 8, 9% stock return.
Right.
And it's a mind shift for a lot of people. And a lot of people wait and get to the point where, oh man, I haven't done any tax planning, and we need to jump in and figure that out.
Yeah.
Yes, makes sense. But when does it actually make sense for someone to think about doing a Roth conversion?
The younger, the better.
Yeah.
There's a little caveat. If you're under the age of 59 and a half and you do a Roth conversion, which that means take your pre-tax IRA money, you move it to a Roth tax-free account, but that's a taxable event, you have to pay the tax due out of another bucket of money. Because you're under 59 and a half, they will ding you with a 10% penalty.
That just seems so
I know.
irritating.
So for the
doesn't
younger
it?
people that want to do conversions, there are some things we got to make sure we need to do, but any age can look at Roth IRA conversions
Right.
is the answer to
Okay.
your question.
Right.
Any age. Okay,
Any
so I
age.
have to ask you a question. How do you help clients determine how much to convert and when? Overall, what does that strategy look like? Because I know the viewers are leaning in right now and they're thinking, how do I apply this to my tax strategy? How much to convert and when?
Right.
Well, basically, everybody that comes, I'll lean in too.
Yes.
Everybody that
Yes.
comes through our door, everybody has a different situation, right? So what is the most appropriate thing? Do we want to stay within a certain tax bracket? Do we want to stay with so that we don't affect Social Security or Medicare? There's a lot of factors that go into that. One of the things that we do is we'll actually take a look at your tax returns from last year, run it through a sophisticated software that will actually give us a lot of things that we can do to the penny as to how much we can convert.
Yeah, well, think about it. Like you said, everyone's situation is different. Their deductions they have, their tax, the property tax, the mortgage interest, the kids that they have, their charitable deductions. We take the tax return and upload it into our software, and we can project different levels of Roth conversions to say, let's not trigger too much tax. Let's do it efficiently.
All right, so like one step at a time. Well, Jordan, I know that you and Adam have a very special message to our viewers at home today. We're going to give people the opportunity to get ripped. Let's talk about it. What is getting
That's right.
ripped?
Yeah, our
Let's
offer
get
today for
ripped.
everyone that's watching is to call the number or click the QR code to come in and get your own personal financial plan. We call it a RIP report, but a written financial plan is so valuable. RIPT. The first is risk. How fast or slow are you driving your portfolio? We can help you figure that out and help you with adjusting that if need be. The I is the income plan. Do you have a roadmap to get you through retirement? What if you screw up and live too long? Do you have an income plan, or is it more of a guess? The P is portfolio. How healthy is your portfolio? What fees are you really paying? The all-in fees, as we say. How healthy is that portfolio? And the T, the taxation, what we're talking about today. Have you gotten Uncle Sam out of your pocketbook? We can show you how to do it. We'll also throw in a copy of our new book, Main Street Millionaire, How Real People Build Real Wealth and
keep it.
I love that. Jordan, thank you so much. And Adam, thank you so much. To our viewers at home, this is your opportunity to get ripped. Go ahead and call into the number you see on your screen, 888-462-7839, 888-462-7839. Or simply grab your cell phone, click on the QR code at the bottom corner of your screen. That is going to be the fast track to get on the schedule at Main Financial Group. Once again, just click that QR code. We're just a click away. We'll be right back momentarily. I have so much more with Adam and Jordan on the Main Money Show, where Wall Street meets Main Street.
I was an accountant by trade out of school, out of Michigan State, and I absolutely hated brokers, financial advisors, whatever they wanted to call themselves. I was a tax accountant, and we would share a mutual client. And this broker would advise our mutual client to buy, sell, and never do any tax strategy. And I was left to clean up the mess. So I went to the client and said, please talk to your broker and tell him to knock this off or begin to do some strategy. And the typical broker response was, I'm not licensed to do that. I can't talk about taxes. So I basically decided to get my investment securities license and all my other licenses out of spite so that we could do all the tax planning as part of the investment strategy for our clients. The value of choice, as we always say, if you go to a big box firm, they're going to have one of 6 portfolios, let's say, and you're going to fit into one of those. The value of working with an independent advisor, especially a fiduciary like we are, is that they have to do what's in your best interest, and they can use any program that's licensed out there in America. So a huge difference. After 20 plus years on this side of the fence, I think our industry does a poor job at explaining to the public the difference of those two. I come from a culture of helping people and educating them, not just telling them what to do. So I think people that truly want to educate make a big difference in this industry.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Main Financial Group, and we're talking all about tax-free income in retirement. Who doesn't want that? But how do you get it? We're going to talk about some strategies right now. So thank you for being with us. Adam, I love your hat.
Uh-oh, Uncle Sam
Uncle Sam
has joined us in the studio.
I'm Uncle
Wow.
Sam, and I do not want you to do anything with Roth. Keep growing that IRA account because I get more money in the future, and I want to raise taxes in the future. No?
Okay.
No?
Well, I was going to jump into maybe some solutions, but I think that hat makes me want to ask one question beforehand. So,
Okay.
Uncle Sam, I'm going to ask you this question. Why
Uh-oh.
aren't more people taking advantage of Roth strategies earlier? Is it because you are greedy and you want more?
Yeah, well,
Okay.
now I'm not Uncle Sam anymore.
Okay. Well, that wasn't fun for me because I was guiding it to you like you were.
No, but I think the reason why is that it's a bitter pill to swallow all at once or right away,
Yes.
right? They're I have to pay taxes now to this guy, right? I have to pay taxes to Uncle Sam now. Yeah, but there are reasons why if you're doing it now makes a lot more sense than doing it later. What if we have legislative risks, right?
Yes, yes.
Congress changes the rules. Maybe they change the rules on the Roth accounts.
Right. Well, and I think there's a whole nother side of that question, Cynthia, is why aren't people taking advantage of Roth conversions? Because their
Yes.
advisors are not talking about it. And why is that? Either they don't understand them, their employer won't allow them to discuss taxes because they're not properly licensed, which our office is properly licensed to talk about taxation and tax planning.
Yes.
Or more importantly, the big advisors, if you convert dollars from a pre-tax IRA to a tax-free Roth, there's a big chunk that's owed in taxes, Cynthia.
Yep.
They're going to have a lot less money to manage if I'm an advisor XYZ over here at a brokerage house.
Yes.
And so a lot of the big firms, I don't want to pick on any individual ones, won't even allow their advisors to go down the road of Roth conversions because it's going to lower their assets under management.
Oh,
if you follow
wow.
my train of thought there.
I
you mean
totally
like
do.
Smorgan Manley?
But you know that's how I essentially got into the business. I was an accountant that got sick and tired of the brokers buying and selling and causing taxation on the mutual clients we had without doing tax planning. So we got into this business, this investment side of it, to put the tax plan as part of it.
100%.
Well, and I am so glad that you did, Jordan, because your information that you share each and every week to the viewers in the Detroit area, it is so welcomed. And I'm so honored to be your host because I love to see the calls that are coming in every week, the emails that we've done in the past, the email shows. Thank you, viewers at home, because you know Jordan's the right one to follow, and Adam as well. So, question I have, and this is often very confusing. People are trying to understand what is the difference between Roth contributions, Roth conversions. Those two things, they seem to be a little confusing for most people.
We know a lot about this. So there are several ways to get dollars into a Roth IRA. So they use these words conversions or contributions. So
Yes.
let's start from the beginning.
Okay.
I get excited about this, so let's go. Okay.
I can tell. I love this.
The first two ways are contributions.
Yes.
Well, there's two types of contributions. There's a traditional Roth IRA contribution. It's, I think, $7,500 a year. In 2026, if you're over 50, you get a catch up. You can do a little more.
Yep.
But if you make too much money, you can't do that. So there's some limitations there.
Okay.
You also have Roth 401ks now that are offered through your employer.
I
So
like
you can
that.
choose payroll deductions to go to your tax-free Roth 401k, not to a pre-tax 401k. So those are two ways to get contributions in.
Okay.
Now let's look at conversion. So in 2010, they changed the rule that anyone at any time could take any amount of IRA money and essentially recharacterize it or convert it to a tax-free Roth.
From Judaism to Catholicism.
No, not that.
No?
Not a conversion that way.
Oh.
So, and it's a taxable event to do so.
Okay.
Doesn't matter how much money you make or how much you want to do at any point. So that's what we call a traditional conversion.
Okay.
Then they came out with some, let's call them combos. Let's do a contribution and then a conversion. Well,
Yep.
what does that mean? You can do a non-deductible IRA contribution, $7,500 as well as that limit, and then you can convert it to a Roth IRA, and they call this a backdoor Roth.
Right.
Interesting.
So that's a way where it's a combo. You see what they did a contribution and then they converted
And
it.
did they do that because of the higher income people?
Correct.
Yeah.
So the people that could not, that made too much money, that couldn't put directly into a Roth, they call it a backdoor, a way to get money into a Roth.
Oh, but talk about the other.
Then there's the mega super
duper
backdoor
mega
Roth.
something like that.
They call it several things, but essentially is if you have an employer-sponsored plan, you can do non-deductible contributions to a retirement account. So you don't get that pre-tax deduction. It's upwards of almost 80,000. I think it's the high 70s this year.
I mean, that's crazy.
And then you can convert that chunk into a Roth IRA. So you contributed and then you converted a very large amount and you weren't penalized for too much income.
Wow.
So those are 5 different ways of, 1, 2, 3, 4, 5 different ways of how to get money into Roth IRAs. So it's very important that you're working with a firm that understands and can navigate these complex tax strategies.
He understands it.
We can show you how. We've got great software. We've got a great team of people to put plans together for you.
Well, and I love this because I know that you help a lot of high net worth individuals in Detroit, in the area surrounding, if you will. So can you convert that entire amount at once if it's $1 million? Let's just say that someone in the audience right now, they're like, I've got this nest egg, but I don't have a Roth. What's the strategy for someone that's high net worth like that? Can you do it in one calendar year?
You can, and if we look at it, and I think we've got a graph of the tax brackets. You know how our tax brackets work? It's like what was that in chemistry? Graduated cylinder. It's on the screen now. So we are all taxed at different rates on the way up. So you, me, Adam, we all pay 10% on the first 24,000 and change of income we make, right?
Yep.
And then the next unit of money, we pay 12% and so on and so forth. So we're taxed at different ways on the way up. But if you look at the highest bracket at 37%, doesn't kick into over $768,000. So there's a lot of threshold between each bracket. So the idea is, yes, if you're a multi-millionaire and you're already at the 37% bracket, you can do it all at once and you know you're going to pay 37%. But most people aren't at that level, and they're somewhere in between. We can look at their current tax return, their current deductions, use our software, and give 2 or 3 different options without going too far up the ladder, meaning causing more tax.
Right. Hey, Randy, if you could put that back up on the screen there for a second. Okay. I also want to point out to everybody that the tranches between each level are massive.
Yeah, looking from 22 to 24 goes to from 211 to 403.
Oh, wow.
$200,000 between those two.
So the answer to your question is that somebody who has $1 million and wants to do that over the next 3 years, we absolutely could keep them in a tax bracket that would be much more manageable.
Oh, we could convert $1 million over a period of 3 years and stay in the 20s as far as tax rate.
That's
and if you look at it
incredible.
from the history of taxes, the highest rate ever was 1944. It was 94%.
Wow.
In the 60s, it went down to 82 was the highest bracket. In the 70s, it went down to 70.
Yep.
And we're only at 37. To think about converting $1 million, doing it strategically, and only paying 24 to 26 effective tax on that, that's on sale, guys.
That's amazing.
And that's the bracket. That's not even the effective tax rate, right?
Right, the effective rate would be
It just makes sense to pay taxes on the known rate versus the unknown. So these strategies are really amazing. But Jordan, it's time for you to give the opportunity again.
Well, again, yeah, absolutely. We want to offer everyone watching today to come pretend be our clients. We want to treat you like our clients for 2 days. We'll give you your own personal written financial plan. We've got multiple offices around Metro Detroit, and we'll give you a customized written RIP report. RIPT, a risk evaluation of how much risk you're taking on in your portfolio, an income plan, a written strategy through all the navigating retirement. The P is the portfolio health, show you what you're really paying in fees, how your rate returns, R, and the T, what we're talking about today, we can show you how to get to a completely tax-free retirement plan. It just takes a phone call or a click on the QR code.
I love that. And who doesn't want a tax-free retirement plan? Who wouldn't want that? The number to call is 888-462-7839, or simply grab your smartphone and click on the QR code at the bottom corner of your screen. That's going to be the fast track to get on the schedule at Main Financial Group. We're talking about a tax-free income for your retirement years. So are there different strategies for when we experience market downturns? We're going to talk about that in the next segment. Stay tuned.
According to a recent Transamerica retirement survey, over 1/3 of American workers have already dipped into their retirement savings to handle day-to-day expenses, and nearly 40% have reduced their contributions.
For those approaching retirement with significant assets, this may sound like someone else's problem, but it's a warning worth noting. Economic pressure doesn't discriminate. High net worth individuals are just as vulnerable to reacting emotionally during times of financial stress.
The key is discipline and a plan that involves with changing circumstances. Having a tax-aware, income-focused, and flexible strategy in place can help you avoid short-term mistakes that impact your long-term goals.
Because real success in retirement isn't just about what you saved, it's how you protect and use it.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Main Financial Group, and we're talking all about tax-free income in retirement and who doesn't want that. And gentlemen, I'm so excited. We were talking about this on the commercial break. See, Jordan and Adam, your energy is infectious, and I want to talk about this because I was like, yay, this is great. MainTaxBill.com.
Whoa.
MainTaxBill.com. That tool is so amazing because people right now in the viewing audience, they're probably wondering, okay, what is my tax burden and how do I know if a Roth conversion would really be applicable to my situation? MainTaxBill.com.
This is the first I've ever heard of this website.
Really?
Stop it.
Well,
Yeah,
gotta talk to Jordan.
we're pretty excited about this. This is a free tool calculator that we put online that anyone can use. So all of you watching at home, even advisors out there that are there, go ahead, use our free calculator tool. So you really just enter a few pieces of information, your age,
Yes.
how much money you have in retirement accounts, and then you can toggle and select different scenarios
Yes.
of what you think you'll pay going forward in taxes, your rate, and what you think the rate of return will be on your assets. And the report will tell you if you do nothing and keep this IRA, and the software has you living everyone to 95.
Okay.
It'll tell you
okay.
how much you pay in total tax
Yep.
versus if you do a Roth conversion, how much you'll pay in total tax.
It's amazing.
And as our friend Brad always says, you cannot unsee that number.
No, you can't.
That is true.
When you look at it, we had a 65-year-old that had $1 million. We did 25% in tax rate and a 5% growth rate over the 30-year period. That $1 million cost them $980,000 in tax if they did nothing.
Crazy.
Because there's required distributions, there's all kinds of other things that go into it. Versus if they converted that at 25%, that's $250,000. So, that's a $700,000+
Absolutely.
benefit just by moving money around between pockets. And then it gets worse for the younger people. We had a 55-year-old, same thing, $1 million, 25% tax bracket, 5% rate of return. That $1 million IRA costs them, what, 1.6 or 1.7 million of total tax.
Ridiculous.
Versus if they convert, it's the same number, right? 25% of $1 million is $250,000. That's nearly
Wow.
1.3 million in tax savings.
Yes.
So the calculator is free. Anyone can use it. MainTaxBill.com. It's a wonderful tool.
And you
really
said
is.
it goes to age 95?
Yeah.
Oh, good. I'm 5 years away from that.
Oh my gosh, Adam, I just adore you. Okay, so let's talk about something that happens often, right? Markets go up, markets go down. So when we're talking about market downturns,
Yes.
is that an opportunity for a Roth conversion, and why?
100%.
Oh, it's
Yeah,
great because
absolutely.
think about the conceptually. You are converting an amount that you think is on sale because let's say you owe X amount of shares of Apple.
Yeah.
And Apple's down 30%. And you decide that you're going to convert those shares to a Roth. You pay the tax due out of cash savings elsewhere.
Yep.
You still have the same number of shares of Apple that you had before the drop. And now it's in a tax-free vehicle. So when the market rebounds, all of that rebounding growth is what?
To profit, pure profit.
100% tax-free.
Tax-free.
And so when markets are down, whoa, is there an incentive to do Roth conversions?
Yeah.
Because you're
Yes.
converting a lower amount and then you're catching all that rebound 100% tax-free.
Amazing.
Yeah.
That is really great, but are there any risks when you convert too much too quickly? We talked about that briefly before, but talk a little bit about more in depth, please.
Yeah, well, I mean, obviously, if you do too much too quickly, then we're dealing with. Why would you? If you did $1 million and you did it all at once, that's a
Yes.
37.
Right, but then
Right.
blended in, you're effectively paying around, just use about 30%,
Yeah,
right?
30%.
So there's 300,000 you've just paid.
Right.
Versus
if we did it, try to keep it 22 to 25%, that's only $250,000.
Yeah,
So
you save money by doing it strategically, by having control of your tax brackets. So exactly right. Don't do it all at once. Do it strategically, and then all those extra tax savings go to tax-free growth.
this is I have to say, this is not a DIY type of thing. You really do want to use somebody that is familiar with this, even if it's not us, although we would like it for it to be us.
Yes.
You need to have guidance for this. This isn't a ChatGPT thing. This isn't a DIY.
Yeah, the tax tool, the calculator we have is to give you a general idea of what your tax exposure is. But when you come in and see us, we've got the actual software, the tax software, the planning software to be able to customize it exactly for what you're trying to do.
Correctamundo.
I absolutely love that. So does this give someone more flexibility when they're utilizing Roth accounts? How does that change someone's overall retirement trajectory?
Oh, well, I mean, think about it this way. You convert it young enough, you're not having to worry about RMDs, required minimum distributions, right? So that in itself, if you derive income from that Roth account, you're not affecting your Social Security, you're not affecting your Medicare. It leads you in a lot of great directions.
We have a client from Ford Motor Company. We'll call him Rick. Several years ago, he decided to convert everything, his pension and a lump sum, his IRA, everything into a Roth. He's now pulling out $250,000 a year in a Roth, not paying any tax. Well, wait a minute. Because he has no taxable income, his Social Security is now 100% tax-free.
Wow.
$300,000 a year, zero tax. Meanwhile, my mom, who's a widow, retired school teacher, has a taxable pension from the state of Michigan. She pays tax on her Social Security and at a higher rate because she's single. So to that question of how can some of these strategies, these Roth conversions impact your retirement? Well, look at Rick and look at my mom. Two totally different paths in retirement because of tax strategy. Now, my mom didn't have the ability because she has a pension for life. We can't make those changes.
Wow. Well, this information today was just amazing. Viewers at home, we want to give you the opportunity to get ripped. Call in today, schedule that consultation, 888-462-7839, 888-462-7839, or you can simply grab your smartphone and click on the QR code at the bottom corner of your screen. That's going to be the fast track to get on the schedule of Main Financial Group. Be safe, be happy, and be blessed. We'll see you back 1 week from today on The Main Money Show, where Wall Street meets Main Street.